Now let's look at the balance sheet. The same data when we see, the balance sheet is also more of a streamlined format itself, right? There are two major sections which are shown in the balance sheet of any company: the equity and the liabilities. Generally, the difference is nothing but equity is nothing but the owner's part of it, what the company needs to pay to the owners and shareholders. All of us, whosoever have bought the shares of the company, what the company is liable to pay to them, that is treated as equity portion. Whereas all other things to others, probably it could be some payment to the bank, some payment to the vendors, some payment to the government in the form of tax. So whatever are the other outstandings the company is having, some payments to employees, salaries. So whatever are the other things except the owners and the shareholders, they are all treated under liabilities part. The owner means when I talk about the word owner here, even one shareholder is also a owner. So whatever the company is liable to pay to the owners, that is being treated as a part of equity part, where this portion is what is typically contributing to the equity part or the owner's part, whereas this entire thing is the area where the company is liable to pay to some other parties. So the whole set of liabilities which the company has to pay to others, outstanding on that date, to be paid to someone else, they are all called as your liabilities and equity. Whereas what all the company has to receive as on that date from some other parties, or it has already, if it sells it will receive kind of stuff, they are all treated as a part of assets, right? So if we go one by one, under the liabilities part, and the reason why it is called as a balance sheet is your total equity and liabilities should match with total assets. Total assets always match with the total equity and liability. That is what is the balancing part. The total assets always match with the total liabilities and equity. That's the reason it is called as a balance sheet. It balances the liabilities and the assets, they balance each other. The reason is every entry that we think of, it will impact the balance sheet at two different places, typically called as a double entry system. The impact is always at two or minimum or more than two places. Let's say we were talking about some time back that let's say the salary is pending, right? And if the salary is pending, obviously it may go as a part of, let's say, some other current liabilities. That because it is just current. The reason why I'm saying current is within the next 1 year the company has to pay. So what will typically happen if it pays, let's say that 300 crores, suddenly this liability will come down by 300 crores. From 984 it may come down to 684. So your total is coming down by 300. Because how did the liability come down? Cash went off. It paid. It paid means cash has gone down. So literally cash is there as a part of the assets. Even this will come down by 300 crores. So both the liabilities is decreasing by 300, assets is decreasing by 300, again a balance. So if you think through any transaction, it will reflect at two different places. Either one asset will go up, another asset will come down to balance it, or one asset will go up, liability will go up, balance. Asset comes down, liability comes down, balance. Any of these can happen. Probably two assets go up, one liability come down, or one liability go up. Even those also are very much possible. Right? You have raised a capital or you have taken a loan, 100 crores. With that 100 crores, 50 crores you have bought a machine, another 50 crores you have invested in some other company. Right? So, in your liabilities, you are now liable to pay to the bank 100 crores. So, your liabilities are going up by 100 crores. You have invested in two. The fixed asset, the tangible assets will go up by 50. Your non-current investments will go up by 50. So, these two are increased by 50-50. Whereas this is increased by 100. So, assets are going up by 100 overall. Liabilities are going up by 100. Only then your balance sheet is balanced. So, the main intention in a balance sheet is whatever are your total assets and total liabilities, they will always balance each other. Right? Now, what is the? This is the cash balance. Huh? You know what is the cash that is present in your various accounts, right? How much cash is present in the bank balance? How much cash is present in the form of checks which need to be deposited? Whatever is the cash that is present in your account, that is what we are putting as a cash here. So what is happening, literally speaking, from 66 crores, your cash has gone to 849 crores, which means in this 1 year, your cash has actually increased by almost 800 crores. Right? Whereas your profit is only 690 crores. This profit is not a cash. This profit is the retained earning. It's a equity capital. It's an addition to the equity capital. So that's where if you see I have put up the formula also here. B5, which is the previous year's capital, plus the new capital that got added up because of the profit that was retained. From the income statement, whatever was the profit, that got added up to my capital. So my capital is going up, right? But see the cash, see the capital need not be equal to cash. It may come at a later point also. But that entire profit is not distributed. It is retained back into the business. So that's the reason I am putting it as a part of the capital. But the cash, okay, if I am talking about the cash will come as the outcome of the cash flow statement. Probably if you see here, the net increase or decrease in the cash is 782 crores. That is what is the increase which is being seen here. From 66 crores, you add 782 crores, it's becoming 849 crores. So, from a cash flow statement, what is the cash that is increased or decreased exclusively for this year? That is what a cash flow statement is driving us. Whereas a balance sheet, cash flow statement, increase or decrease in the cash position exclusively in this year. For this year, how much cash is generated or how much cash is lost. Exclusively for this year. So this year's cash, I add up to the balance as of last year end. That will give me my this year end balance. The last year 66 crores was there in my account. This year Our business has generated around 782 crores. We'll see how it came out. This year the business has generated 782 crores cash. Profit was only 690 crores. Cash was 782 crores. So cash has no relation with the profit. In some cases it will be more, in some cases it will be less. So that's where we have to look at a cash flow statement separately from a P&L statement, right? So because the cash is purely the reality concept, because what you will take, your sales was those many crores, but you had yet to receive 1900 crores. So it is telling you what was the cash actually received. So if I make a statement like that, what is the final net cash that I have received exclusively for this year is what is this 782 crores. So this 782 crores is cash that is generated exclusively in this year. I add up to the balances at the beginning of the year, which is 66 crores. It gives me the end of the year balance of 849 crores. Right? Now, let's go back to this understanding of the each and every item. Okay, this is a very important thing to focus on. So first the equity part. There are two parts to it called share capital, reserves and surplus. This is also called as, in some terminology, this is also called as retained earnings. Retained earnings are retained profits. It is nothing but, how does it work out is, any company, when it starts its business, there is some capital that goes into it, right? The way that capital goes into it is, let's say the company wants to go ahead with 100 crores of capital, right? What they do is, this 100 crores, they will break it out into 10 crore shares. Just I am giving you a base idea. 10 crore shares of 10 rupees each. So each share, it's just like they wanted to break it as small as possible so that they can sell it even as one share, two shares to various people. So the intention behind it is, you break down the total capital that is getting invested in the business into some number of shares of some value each. The value generally is not more than 10 rupees a share. Today for some companies even we have 1 rupee share kind of shares, because if I make it as 1 rupee share, then it means 100 crore shares are getting created. Instead of 10 crore shares, 100 crore shares of 1 rupee each. So if let's assume that I am talking about 10 crore shares of 10 rupees each, right? So this is the total share capital of the company. Which means at the time of start of the business, the company has really broken down the total capital into some number of shares. So the total capital is 100 crores, right? For which probably, see, there are again 2-3 words to it. This is what is authorized. The company is authorized for this business. It is authorized for a capital of 100 crores. But it may raise capital only for 90 crores. Maximum limit is 100 crores. Right? But it may raise till today even a 90 crores only. Because for a business, it may want to raise it at a later point in time, the remaining 10 crores. So it has raised, let's say, only to the extent of 90 crores. So the 90 crores means 9 crore shares of 10 rupees each are issued to various. This is what is called as an issued capital or subscribed. People have purchased it. People have invested in it. People have invested this much. Now what happens? After the company, every year, the company makes some profit. Some portion of the profit is retained back in the business. Right? Let's say it has made a 10 crore profit, and let's say 8 crores is again invested back into the business. 2 crores is being distributed by all these 10 crore shares, which means each share will get 2 rupees. Right? 10 crores, sorry, 20 crores, let's say is, no, 2 crores is the profit that is distributed, which means each share will get 20 paisa. 2 crore shares, 10 crore shares, 2 crores is the profit. So per each share, they are getting 20 paisa. 20 paisa is the profit that goes to each shareholder, and the remaining amount is invested back into the business. Correct? Now, which means what is happening? The total share capital that is present in the business now is 90 crores plus additional 8 crores has come in. Additional 8 crores has come in because the 8 crores which has to go as profit to the investors, it did not get distributed. It was again brought in as additional capital into the business. So the capital today is actually 98 crores. 90 crores in the beginning, 8 crores retained. 98 crores. So, but the number of shares are still 10 crores only, or probably 9 crores only. Number of shares are still 9 crores only, which means per share, now the value has become almost 11 rupees a share. 11 rupees is the value of the share. Like that, what happens year on year? The value will keep going up. The value per share will actually keep going up because the company will keep investing back into the company. Right? Some portion of the profits is retained, invested back into the company, and blah blah blah, which will increase the value of the share. Now, after few years of operations, the company may think of expansion. See, every year 8 crores reinvested back, another 8 crores, another 10 crores. The growth is only limited to that extent. But suddenly the company wants to double its size, triple its size within no time. The retained profits are nowhere sufficient because profit hardly, let's say 20% of the sales is the profit. Out of that, another 20% they retain, 80% they retain, 20% they pay. Still, it will not be a sizable amount. It will still be a smaller like this. Every year, some 8 crores, 10 crores. This is what they can add to the business. But if I want to double it, I want to add another 100 crores to it. This is where what the companies look at is they think of raising capital from outside sources. And the most important source through which a company raises the capital is called as your IPO route, initial public offering, which is the entry to the stock market world. Initial public offering, which is more like you are typically, your company is becoming a public limited company. Public will become shareholders in your company. Till now, all these 9 crore shares probably are with 2 of you or 3 of you. One of you is holding 5 crore shares, someone else is holding 3 crore shares, something like that. Hardly 3, 4 people, 5, 6 people, 10 people. But now, these 5, 6 people cannot supply that 100 crores extra capital. That is where you are looking at the extra capital coming from public. All of them, okay, we'll give you 10 shares. Each share probably is now, by this time the share value is keeping on growing up like this. So it may so happen that after few years, that may become 50 rupees a share. Like this, I mean, retain. And The company is also performing every year. So because of these things, it may so happen that the company's share price keeps increasing. So after 5 years or 10 years, when the share price of the company has reached to some extent, the company might say, we still need more capital. So let's go and raise it from the public. We want to double it or triple it. Our company needs to be doubled within next year. So that is the typical growth today most of the companies are looking at. If that is the case, they need capital from very heavy capital. Probably it's just not 10 crores addition every year. They need a 200 crore addition next year. So there is no internal source to provide that 200 crores. If it is 10 crores, 15 crores, they can have retained profits. But if it is 200 crores, retained profits are nowhere sufficient. So the best thing is they raise it through the public. They raise it through the public. So that is why they call it as we are going public, or the typical technical name to it is we are going for an IPO. Initial public offering. We are selling the shares to the common public. So it comes out in all the newspapers and lot of places that per share, this is what is the price we are offering per share. And for this, an investment bank comes into picture to assess what is the real worth of the share. Sometimes what they do is, if the company is really doing well, though here the number is let's say 50 rupees a share, after retention, it is 50 rupees a share. But what the investment bank may do is, no, this company is having a very good growth potential. So let's position it to the public at 80 rupees a share. They will have a valuation mechanism, and they will decide at what price one share needs to be sold to the public. They'll say probably let's decide 80 rupees a share or 100 rupees a share. Now, when the public subscribes to it, what is the face value of it? Face value is still 10 rupees a share. The original value was still 10 rupees a share. The premium which they have paid on it was 90 rupees a share. That's where they have paid 100 rupees. The premium over the face value is 90 rupees a share. The actual face value is 10 rupees a share. Right? The actual face value is what will go into the share capital. So that's where you don't see much change in the share capital. Unless the number of shares have gone up drastically, you don't see any change in the share capital of the company. Because share capital is nothing but the actual number of shares multiplied by the face value per share. Face value is always 10 rupees. The value at which it has started. That is what we are calling as the face value. Because it's like this. After every year, a new capital is coming into the business. Number of shares are still the same. So the share which started at 10 rupees now has become 90 rupees. Sorry? Private means, see, okay. Oh, when they initially made it, see, typically they have to get an approval from the registrar of companies. When they are registering this particular unit as a company, then only the capital and the price per share, how many shares, they are all decided, whether you are a private or a public. So after that, your financial statements will tell you what is the total capital that is there, and how much has been the capital growing over the few years. So that is what is a decider of what is the what is the premium that is existing per share as of that particular date. Now, anything excess, the people are buying it in public. As I said, the 10 rupee share, when it comes to market, it may come at 100 rupees a share. Because slowly every year, some retained earnings are increasing the value of the share. Let's say it has come to 50 rupees a share by the time the company is going public. And at that time, the company will hire an investment banker who will assess the real worth of the company from the market dimension, and he will suggest one price. Okay, let's because of the demand which our company is having, let's price our shares at 100 rupees a share, not 50 rupees. So it will be priced in the IPO market at 100 rupees a share. Now, common public, all of us, if we are very much interested, thinking that yeah, this company will definitely keep performing. So even though I put 100 today, within 2 years it may go to 140, 150. So company wants heavy capital. See, it's like this. Now, let's say I started my business with 10 lakhs. After that, I pooled some more people. They were able to give me 1 crore altogether. But I want to expand my company into 20 geographies, something like that. I have developed a big business plan for a major expansion. I need capital. Where can I get the capital from? Up to, let's say, another crore, probably someone else may fund. A bank may give me a loan, but I need 50 crores again, or another 20 crores I require. If I want another 100 crores, I can go for a again increase in the authorized capital. With the registrar of companies, I can very well go for increase in the authorized capital. So it becomes now 200 crores I am authorized to raise. Whereas I have only 90 crores with me. So remaining 110 crores I want to raise either through a bank loan or through public shares. So whenever I feel that bank loan also is very risky, because bank also looks at some collaterals or something like that. I may or may not have that much, or I may not be willing for that much. In that case, if my company is already an established company, people may be ready to invest in my company, probably 10,000, 20,000, 30,000. They are ready to invest like that, and all people's money put together may come out to 100 crores. Right? So then what is happening? Whatever are the total number of shares into the face value, which is 10 rupees per share, is what will go into the share capital here. That excess what has been given, right? They have purchased it at 100 rupees a share, not 10 rupees a share. That excess 90 will make its entry into the reserves and surplus. It's an excess but that's also a capital that is contributed. But what the reporting format says is, you separate the share capital, because share capital has to do more with the authorization. Authorized share capital, it cannot cross the authorized share capital. That is standard. So that is given by the registrar of the companies at the time you are filing for your application, at the time you are registering. If you want more, again there is a process for increasing your authorized share capital limits. So you have to make sure that this is within the limits only, which means the number of shares cannot go beyond a certain limit, but per share price can go up. So anything excess that is going up, you are capturing it as a part of reserves and surplus. So during the IPO, whatever the money comes, that entire money comes to the company only. After the IPO, whatever the buying and selling you and I do, nothing goes to the company. Let's say Dr. Reddy's, probably 20 years back, I'm not sure on the date, but let's assume after 20 years back, they have gone for an IPO, which is the initial public offer. First time they are going to the public to raise money. They have gone with some number of shares, and at some price, they have priced it. Some premium could be there over the price, blah, blah, blah. Now, whatever those people who have purchased during the IPO paid for it, that entire amount came into the company itself. The 10 rupees per share came into share capital. Whatever the remaining 30, 40 rupees per share, it came into the reserves and surplus. And after that, every year, the company is generating some profit, retaining some profit. That retained profit is getting added up here. It is reserves and surplus. It keeps. Which one? During an IPO, the share capital, that number of shares into 10 rupees per share, that goes into the share capital. And in that IPO also, whatever the premium they have paid, see, the share capital is 10 rupees a share. But let's say when the company has gone for an IPO and priced the share at 100 rupees per share. The accounting wise, let's say we have 800, let's say 8,000 shares. Let's say there are some 84 shares. Let's say there are 84 shares. What is happening is 84 into 10. So actually the company has got how much? 84 shares into 100. It has actually got 840 or 8,400. Correct? Out of that, the breakup is 84 into 10, which is 840, is the share capital. And the remaining 90, 84 into 90, that goes as the reserves and surplus, initial. Right? So that means the total capital is 8,400. It's only the breakup between share capital and reserves. And after that, the company does the business every year. Profit is generated every year. Whatever is the profit, dividend is paid. The remaining is retained. That retained part keeps getting added up to this reserves. If the company makes a loss in a particular year, the reserves will come down. Company makes a profit, the reserves will go up. Reserves are nothing but it's a capital of the company. So, as of this year, this company is having 6,700 crores of capital with it. Right? 6,000, which is the share capital being 84 crores and the reserves being 6,626 crores. Overall 6,711 crores of investors' money is present with the company. At different points in time, the investors have contributed that much money. At the IPO, they have contributed some money. After that, every year, their profits are not paid to them in full. Every year, some portion is getting back into the company. So that is also like the investor is contributing additional money to the company. So till today, all investors put together, they have contributed 6,711 crores to the company. Now, typically what happens is, or what is one more point to be considered is, after the IPO, where all the shares are given to someone or the other, right? All the shares which the company wants to issue, they are all given to someone or the other. No new share can come into the market without authorizations. Right? So, after that, the people who have purchased their shares, they will start trading on their shares. They want to sell off. Someone else want to buy. It's not new shares getting created. Those, so only when there is a seller to the existing share, then only someone else can buy. That's the typical mechanism. So that buying and selling process of the shares is what is facilitated by stock exchanges. Right? So no new share comes into a stock exchange. It's a secondary market where whosoever have bought the shares in the IPO, they are trying to sell off their shares, and someone else, it's like a market. Someone is trying to sell his share, someone else is showing interest in buying it, because I might not have bought the share in the IPO, but today I want to buy it. Probably it may be available at a higher price, lower price. That's a market, demand and supply now. Now from that point onwards, everything is demand and supply. Probably if there are so many buyers interested in Dr. Reddy's shares and sellers are very few, the price keeps going up. It's a pure market. It has now it has become demand and supply. More and more demand for it, the price will go up. More supply, less demand, the price will come down. So from here, whatever is the price that is coming up, not even a rupee comes to the company. Everything is between the buyer and seller. You sell your share, I am buying my share, I will pay directly to you. The company is nowhere involved in it. The trading process after the IPO, this is what I am saying. During the IPO, any money that is coming, that goes to the company and it gets recorded at these two places. But after that, nothing comes into the company. Everything is between the buyers and sellers, because only when a company issues new shares, only then the capital comes into the company. Otherwise, it is between the buyer and the seller itself. So no accounting entries will be affected because of the buying or selling of the shares in the secondary market. Right? So only entry that will increase my capital here is retained earnings, reserves and surplus. The company generating a profit in this year, portion of it is paid in the form of dividend. The other portion is invested back into the company. That is the only thing that will increase the total capital of the company. Not the share price at which I am buying the shares or something. That has nothing to influence on the balance sheet, because that money does not come to the company. That is a trading activity between the buyers and the sellers. Then one more important source, now looking at the other outstandings from the company's standpoint. So basically it's like almost 6,711 crores is the amount the equity investors have invested in this company. So if at all the company has to pay back, see, generally equity investor, the only way he can exit is through the stock market. He cannot exit from the company directly. Company does not buy his share. There are only one or two mechanisms for that, but in general, company does not buy his shares. He has to sell his shares in the stock market. So depending on whatever is the market price, he may sell it at a higher price or at a lower price. But the selling has to happen there, which means someone else has to buy his share, not selling back to the company. So because of that, the share capital does not, shareholders funds does not change. I mean, that does not have any influence on the shareholders fund. But the thing is, if at all the company is winding up, the shareholders, they get whatever is left with the company. It's not a mandatory thing for the company to pay this much to the investors. Whatever is left, they will get. After all other guys, because they are the owners. That's the typical way the owners mechanism works, right? Owners take all the risk. Whatever is is required to be paid to others, after I pay back everything, whatever is left is mine. Right? This is just a notional amount that typically the owners have invested 6,711 crores with the company. Right? But it is not an indicator that the company is mandated to pay 6,711 crores to them. That's the reason there is a segregation between owner's part and the other liabilities. For the other liabilities, it is mandatory that the company has to pay to them. Right? It's like owners have the last whatever is remaining. If more is remaining, they'll get more. If less is remaining, they'll get less. That's the typical way the owner functioning typically happens. So on the other side, the company is talking about other liabilities. If we see the breakdown is between non-current and current. Non-current is long term, where typically the payment period, the outstanding will be closed in more than 1 year, not within the next 1 year, but it may stretch beyond the next 1 year. Like long term borrowing. The bank, I have taken a loan from a bank. The loan may not be cleared within the next 1 year. It may have it may be a 5-year loan or something. It will take 3-4 more years to clear that loan. In that case, I will treat it as a long-term liability. So any payment, anything that the company is liable to pay to the bank, we treat them under long-term borrowings. Sometimes to the government in terms of taxes. Some taxes, the company may defer them for a longer period. The reason being, I'll give you a couple of examples. Every company, it actually files tax. It has to file a tax filing. The biggest problem is there are some differences between the P&L statement that the company will prepare for shareholders' perspective, this kind of a P&L, and a P&L that the company prepares for tax filing purpose. See, in both the cases, I have to file my P&L. I have to prepare a P&L. Here, this P&L, which is for shareholders and all, this goes as per IFRS standards. That P&L, which is primarily from a tax perspective, that goes as per IRS guideline, which is the revenue service, the tax filing department. They have developed their own guideline. Some discrepancies exist between the two, not only for India, for across the world. There are differences again, IRS to IRS, but there is a gap existing between the IRS versus the IFRS. Simple examples like what these IFRS says is, see, we talk about warranty for a product, which is nothing like, probably if a good gets defective, that would be replaced. Right? Now, as per IFRS guideline, if you can reasonably estimate how many goods will come back, reasonably estimate based on your past experience, probably 1% of my goods will come back, 0.5% of my goods will come back. What it says is, you directly, instead of booking your revenues for 100%, you book your revenues only for 99.5%. Assuming that the 5% of, because you are serving those 5% of the goods for free. If you get it back, you are actually giving 2 products for the price of 1. One came back, the other one you are giving for free. So basically what it says is, instead of booking your revenues for all the 100% of the items, you book them only for 99.5%. So you are right from the revenue stage, it gives you a flexibility. as per IFRS. But what the IRS says is no assumptions. Whatever the revenue you have got, you show that. Actual number of goods that got back, you show that those many goods have come back. So that so what could happen is your profit could be more or less. Here you have showed your revenue as 99%, 99.5% item. Here you have showed it as 100%. Let's say only 0.2% of the goods have come back. Then it's as good as you are showing your revenue for 99.8%. But let's say 1% of the goods have come back. You are showing your revenue only for 99%. So if you are showing your revenue for lesser, the tax will be lesser because profit will be lesser. Revenue is lesser, profit will be lesser, tax will be lesser. Whereas otherwise the revenue will be higher, profit will be higher, tax will be higher. There is a discrepancy between these two taxes, what you are actually filing versus what is shown in your financial statement. That discrepancy you don't know by when it will be cleared. It may be cleared within the next 1 year, or it may take 4 or 5 years to be cleared. So that's the reason. That is what we call as a deferred tax. Deferred tax is the name more associated with deferring the tax. Because you are paying either more, because what comes out in your tax filing is what is the actual amount that you are paying. But that may have a discrepancy with your financial statement number, because financial reporting, it allows you for a reasonable estimation. It allows you for a reasonable estimation. And similarly, like that, like a warranty example, there are few more places where there are discrepancies. Like probably depreciation. I was talking about I'll spread the cost uniformly for 10 years. Whereas the tax guys say you can't spread it uniformly. You allocate more for the first year and constantly decrease it over the years. Typically called as a written down balance method, written down value, or reducing balance kind of a method, written down value. So initially the allocation will be very high. Year over year, that allocation will come down. Whereas in the typical financial reporting, we are spreading it equally for 10 years. Profits are different, taxes are different. So there is a discrepancy in the taxes between what you are showing it in your financial reporting versus tax reporting. So that discrepancy in the tax, if you are paying more than what your financial statement is showing, you are calling it as a deferred tax asset. If you are paying lesser, you are calling it as a deferred tax liability, because you still have to pay. You are paying lesser means you still have to pay more. So which is like a liability. You have paid more means you have paid more than what your financial statement is showing, which is more like an asset for you. So that's where you will see, okay, here you will see this item either under the liabilities section or under the asset section. For some companies, it will be under the liabilities section, calling it as deferred tax liabilities. For some other companies, it could be there under the asset section, calling as deferred tax asset, depending on whether they have in the actuals, did they pay more as per IRS, whereas IFRS is showing lesser, or vice versa. So because here you don't know when the reversal will happen. So here it is as good as saying deferred tax liabilities are, as of this date, deferred tax liabilities are 20 crores. Which means the company has paid 20 crores lesser than what is being shown in the financial statement. Financial statement as per the IFRS, that is showing some tax. Whereas they have paid whatever, they will again file one more financial statement as per IRS format to the tax department. In that, let's say they have got that the tax that they have to pay is 100 crores. Whereas here in your financial statement, you have shown that the tax to pay is 120 crores. So you have paid 20 crores lesser. That 20 crores lesser is what is being shown in your financial statements as liability, because you still have to pay 20 crores as per your financial statement. Right? So that is how a deferred tax liability is getting created. So last year it was almost 100 crores. Some adjustments have happened and that automatically came down to 20 crores. Either you must have paid that, right? Because it's a adjustment process. Some years you may pay more than what is required. So for that, no questioning, no complaints will come, because the filing, it's only because of the filing differences between the two. So if more goods have come back, I don't know, I may have to pay a lesser tax only. If less goods are coming back, I may have to pay more tax. So that difference, no one will ask me to pay immediately. That can still be deferred over the periods, because this is just a filing difference mechanism, not the actual difference. It's only more on a notional term. So that's where we are showing it either as a liability or an asset, depending on whether more payment has been done or less payment has been done compared to the IFRS. If I pay more compared to IFRS, I'll show it as a deferred tax asset. If I pay less compared to IFRS, I'll show it as a deferred tax liability. Then the other thing that can come out is the long-term provisions. Probably some kind of, see, companies generally set out some provisions, let's say, to the employees. Leave travel allowance, earned leaves. These are something, gratuity. What the company does in all these, they pay something to the employee. Probably after he completes 5 years of service with the company, some rules they may put, but they contribute some money, which is like they are liable to pay to the employee. After the employee completes some years of service, they are liable to pay to the employee. So whatever those kind of this one, long-term provisions. So every company has some amount of payments to the employee. So whatever the for every year of service which the employee is putting up with the company, their liability keeps increasing. When he quits, probably this much of earned value, these many leaves, right? These many leaves have to be encashed. If at all, whatever schemes are there, right? Sometimes they call leave travel allowance. So if after these many days, this much will be given for the employee for a leave enjoyment purpose. So like that, you have different schemes for which companies are funding. All those are going under the long-term provisions, because they are not for the next 1 year or something. It is for a long-term period. The company has to pay all these things. So typically the LTA, the gratuity is again until when the person retires or something, there is a kind of a lump sum benefit that the company is going to provide to them. If he stays for minimum of 5 years for the company, after that it keeps contributing, and once the employee quits, he can withdraw that gratuity and go. Which is like unless the company contributes something, it cannot. So once it pays, then the transaction is over. But until that time, it's a liability on the behalf of the company to those employees. For all those employees who are completing 5 years, the company has to compute, if they retire tomorrow or if they retire today. Retirement, if they get out of the company today, how much am I liable to pay them? That is what is the liability amount. So that is to the extent of 21 crores here. and other current liabilities, anything which is long term, which does not fall into these three. Sometimes to some of my vendors, I say I will pay you 2 years after. Any such agreements that are there, all those will get classified under the other long term liabilities. So primary differences are: one for the bank, whatever you have to pay to the bank, whatever you have to pay to your government, and whatever the payment that needs to be paid to the employees, the key aspects. Anything else where there is a long term payment, let's say you have taken some license, you have taken some you have taken some license from someone, right? You have to pay back, or you have taken an advance from your agency, some agency. You have taken an advance, not a license fee, customer deposit, security deposit you have taken. Any security deposit is liable to be returned, right? Probably when they cancel off their agency or something, you have to return that money back to them, right? So that's a liability on the behalf of the company. They have taken the money, they have to refund it back. So from anyone you have taken a security, caution deposits kind of stuff, you have to refund them back. So on the companies, they are not the income of the company, it's a liability on behalf of the company. Right now they are holding it as a security deposit, but they have a responsibility to refund it back. So those all can get treated as a part of other long term liabilities, because they also, you don't know when they need not be the case within the next 1 year that security deposit needs to be refunded. Probably it may be after 5 years, whenever they close down the relation, you have to refund it to them. So typically these kind of things are always looked at as long term itself. You don't expect that within the next 1 month or 2 months this guy will close them off and all. So that's not the expectation for these kind of stuff. Whereas when it comes to current, any short term borrowing just for 1 year, see, there sometimes what happens, cash shortage will be there. Cash shortage will come up somewhere in the middle, right? I need immediate money for next 2 months, right? Sorry, overdraft. So there could be shortage for 1 or 2 months. The reason being, probably my customers, I was expecting the money to come from my customers whom I have given on credit, but somehow some delay is happening, right? Probably within another 1 month, 2 months, they are going to pay off. So in these kind of cases, for a very short term, the companies always keep borrowing. The typical mechanism being overdrafts, or even usage of credit card facility is like that, right? When as an individual we are using a credit card, we are using the cash today, but the payment is happening, let's say, after 50 days or something. Until that time, it's a liability on our part to pay to the bank. That's also a kind of a short term borrowing. So all these go as a part of short term borrowings of the company. If at all they haven't repaid anything as on 31st March, they will note it here. So almost 1020 crores was the outstanding short term borrowing of the company during that particular period. So this is again to the government. These are to the vendors. These are to the vendors. Like you have purchased the raw materials or something from your vendors, and you still need to pay something to them, right? So that means probably you will pay it to the next month or whatever, depending on the deal you have between your vendors and you. They have said, okay, I need the payment within next 30 days or 60 days, whatever it is. So that is what is boiling down to your payables. How much you are yet to pay to your vendors? Almost 733 crores is outstanding. Not as of today, as on the 31st March 2012, 733 crores was outstanding to be paid to the vendors. Similarly, if there are again short term provisions, something within the next 1 year, to pay to the employees. Sometimes even the last month's salary could come here, or even something like provision for dividend, right? Provision, as I said, dividend. The company knows that it has to pay, but obviously it will pay in the next year only. So those kind of things generally get carried under the short-term provisions, which means within the next few months they know they are definitely going to pay. And even the tax also, they cannot pay within the financial year. From April to March is the financial year. The profit is computed on 31st of March. Assume, 31st means no one does it on 31st, but the accounts are closed as of 31st, but the calculations happen after that only. And the real payment, the deadline is up to 30th September. The filing, tax filing, and the payment, just like an individuals, right? We have the chance up to July 31st or something to file for your returns and all that. For companies, it goes even up to 30th September, which means the tax which was of last year or this the year completed 31st March, they are paying it in the next financial year only, before 30th September. So instead of directly treating it as a regular liability, they are putting it as provision and categorizing it as a separate liability item. So typically dividends, the items that go in here, dividends, taxes. These two are key items. Because these two, they are paid in the next year only, but determined for this year. So these two contribute. Probably the dividends was almost 220 crores. If you see here, dividend was almost 221 crores. So the major contribution to the short-term provisions typically would be your contribution from your dividends itself. And finally, the other current liabilities are anything else. Typically, employees, one salary pending. Right? One salary pending may not be a regular item. If it is a regular item, they may put it under short-term provisions. But if it is happening only this year, may not occur next year kind of stuff. Next year, if they pay by 31st March itself, or some companies do deposit by 30th March itself. In those cases, it does not get into the next financial year itself. But if they are depositing, let's say by 5th of April, then that liability has to be created. So that's the reason they are all treated generally under other current liabilities itself, not under provisions. If a provision is something, more or less they are assured that this will occur every year, and the payment happens in the next year only. Generally, taxes and dividends are what are going into the short-term provisions kind of stuff. So all these added together is what is contributing to the total equity and liabilities of this one. So in short, the equity capital in the company is 6,711 crores, which means the investment from the investors is 6,711 crores, whereas the loan is 513 crores, or probably short term and long term put together. Our total liabilities is around 3,622 crores. The owner's contribution is around 6,700 crores in the company, whereas all other guys' contribution, because I say these are all other guys' contributions only because you have to pay to these guys, right? It's as if they have invested in your business. Though literally not the case, only these are the guys who have invested in your business, the bank, whereas others, yeah, you have to pay to them, but you did not pay. It's also as if they are contributing to your business, right? With that money, what all this the company do? It has invested that money. Now the total capital that is available with the company is almost 10,334 crores. some portion in the form of equity capital, which was contributed by shareholders. Some portion is there in terms of loans from banks. Some portion is there in terms of unpaid amounts to the required parties. This is also, I mean, unpayment, non-payment is also more like they have given it to you virtually. You have to still pay to them. So with that money, what all you have done, you have invested. Again, your investments are classified into two. Whatever are your assets, again we are classifying them as non-current and current. Non-current, again, tangible, like we have seen that list: buildings, houses, plants, vehicles, they are all tangible assets. So this company has today, as of today, they have all these worth 1896 crores. So if all of them are disposed, probably the company can make 1896 crores cash out of it. So it's as good as saying 1896 crores cash probably could be paid to some of these parties. The typical equation is like this: the worth of all the tangible assets of the company, if I sell off all these tangible assets, the company will get 1896 crores. So probably with that 1896 crores, it can pay off some of these, because it is liable to pay these guys, right? If at all the company operations are shutting down today itself, the company is closed down today itself, how does it work? The assets, which is the worth of all these things which the company is having. If they are all sold off, the assumed thing is the company will get 1896 crores, which it can settle with some of them, some of the liabilities, right? Similarly, intangible asset, there is only 10 lakhs. I don't know what they invested for that. 10 lakhs is the intangible asset that is there. Everything is in crores, only the intangible asset is showing in lakhs for them. Then capital work in progress, long term projects. Capital is long term projects which are in pipeline, which are like semi completed, right? They'll take a couple of more years. They will not be over within the next 1 year. Probably they'll take 1 or 2 more years. Let's say some development is happening, right? Some construction is happening, which will be ready only after 1.5 years. So anything beyond 1 year, or some product development is happening, some software development is happening, which will typically take more than 1 year to be going live. All these will come under the capital work in progress. The worth of them is around 611 crores for the company. So which means that semi-finished kind of thing, if they sell off, it is going to be worth close to 611 crores for them. Then they have non-current investments. See, these are all some of the things which the company is thinking that it will receive the benefit in future, right? These will give some benefit either by selling or by using. If they use it, they will result in sales, right? If they sell it, they'll get some money. Same is the case here. If they use it, it may benefit them in the business. These also, if they continue with it, probably it may generate some other benefit for them in the future. Same thing with the non-current investment, some shares or something from which they are getting the other income, right? What are all the things this company is having? Probably you can look at in their annual report. You see, these are all the shares. They have subsidiary companies. They have invested in some subsidiary companies. You see all the details. DRL Investments India Limited, which is nothing but again Dr. Reddy's itself. These are all some kind of Dr. Reddy group of companies itself. Dr. Reddy's Labs have invested something like this. You see here in the European, in something in Cyprus. They have invested something in Cyprus. They have invested something in Dr. Reddy Labs Proprietary Limited. They are different companies. This is in South Africa. So they have different branches and which are established as different companies, and DRL has invested in some number of shares in those companies. So these are like its own group of companies, right? Whereas they also put in something else. You see here, they have invested in some company called Orangian Discovery Technologies India Limited. We don't know what this company is, but Dr. Reddy's has invested to the extent of 14 crores in that particular company. Then they have some joint ventures. Kunshan Rotam Reddy Pharmaceuticals. Somewhere else, they have invested around 42 crores. And now you see some other Altech Engineering India. They have bought some shares. They have bought the shares of a company called Altech and GD Metla Effluent Treatment Limited. They have purchased some shares in that company. Like this, you are seeing they have purchased the shares in so many. Progressive Effluent Treatment Limited. They have purchased some shares of that company. So these are all the various investments the company is having. Right? So out of this, they keep getting their they keep getting the dividend incomes, interest incomes, and those kind of things based on the model of investment they have done. And there could also be something associated with the long term loans and advances. They have actually given some loans and advance to all the subsidiaries. They may give some loans. That's where we have also seen they got interest out of the loans given to subsidiaries. So they have given loans to the extent of 631 crores to all their various subsidiaries, probably for their initial operations or whatever it could be. They have given the loans. For that, they were receiving some interest also. Right? So this is the outstanding. Somewhere when they have to clear off the loan, those guys have to pay Dr. Reddy's Limited some 631 crores. So these are all the various long-term assets of the company. Similarly, you can also look at the current assets. Where all did they invest? Where all did they invest in the short term? 207 crores. They have invested in some short term investments. What are those short term investments for the company? Again, these details would be there in that notes itself. You see this? They have bought some mutual funds. They have invested in some mutual funds, some UTI market fund, IDFC money manager fund, Reliance liquid fund, Reliance medium term fund. So they have bought some of the mutual funds. These are the few mutual funds which are to the extent of 207 crores. They have purchased the mutual funds to the extent of 207 crores only in this year. Last year their current investments were zero. So probably for short term they must be having some cash with them, excess cash. They thought why to maintain cash in that, probably let's maintain it in the form of mutual fund. Probably you may get better return. If at all things go well, you may get a better return than maintaining it as a cash or a typical bank deposit. So that must be their idea. And why only current investment? Whenever they want, they can withdraw from it. If they have invested in a long term, they can't exit out whenever they want. Right? There will be a lock-in period. All these things could be very well there. So in this, probably whenever they want, they can exit. So that's the reason they must have chosen this current investments route. Then inventories. Whatever are the unsold drugs, raw materials which are not put to production, drugs which are done but not yet sold. Typically the drugs that are available with all the medical shops, they are not yet sold. They are ready but they are not yet sold. So that's where you see the inventories will be very high for this kind of company. because they will produce the medicines and they are stocking them at all the medical stores. Only until they get sold, they are all inventory only for the company. And similarly, trade receivables, you have given your customers on credit. Only after they you have given them on credit, so probably you have a 30-day period or whatever. Only after that you will receive your money. So this much is your receivables. Your cash and bank balance is 849 crores. Short term loans, to some people you have given only for this year, you have to pay back to me within the next 1 year. So just like your long term loans, you have given some of your subsidiaries for a 5-year period loan. For some of them you may have given a loan for 1 year itself. You just, this is for your initial establishment. After that you see your own modes of funding and you pay back my money. That is to the extent of 529. And if there are any other current assets, small here and there, where the company thinks it will get the benefit in the next 1 year, all these are identified as a part of the assets. Now total assets means these are the total benefit the company will get in the future, which is to the extent of 10,334 crores. Total liabilities are also to the extent of 10,334 crores. So which means, see, out of this is a mandatory liability. This is like residual. Whatever is left. So notionally, this is a balancing figure. That's the reason assets will always match the liabilities. This is like a balancing figure. Right? Because the actual liabilities, mandatory liabilities of the company are only this much. Whatever is the remaining, that's something that goes to the owners and the shareholders. But the assets wise, these are all the total assets of the company. That's the reason we call it assets equal to liabilities plus owner's equity. Liabilities plus equity should always match with the assets. It's not assets matching with the liabilities. Owner's part, we don't call it as liability because it's not a mandatory payment. Right? Though it's a notionally, they have contributed. It is like they have contributed this much, but it doesn't mean that it's the payment by a company to them. Right? So if it comes out more after they sell off all these things, whatever really comes up, if it is more, they will receive more. If it is less, they will receive less. That is what is the behavior of any equity investor. Right? So this is the typical balance sheet shape of any company. So using these two, we will look at the cash flow statement aspect of the company.